All right, time to get started. We've got so much stuff to get through, and I appreciate everyone here. And I thought to do something a little different before we get started. Somebody asked me previously about the books that I have behind me. And in fact, I think I have about 700 books in my library at home. And somebody asked me, like, what's a book that you're reading or one that you're interested in right now? So why don't I share that for just a minute? This is one of the most recent books that I've been reading. It's called Good Strategy, Bad Strategy. This book is amazing to help us understand the strategies that businesses do and what they don't do. If you've ever been involved in a strategy session like vision, mission, values, and stuff, it can get confusing. And that book really clarifies. The second book is this one. Many of you may have already read this book, Richer, Wiser, Happier by William Green. William Green is a great author. This book is exceptional. I would highly recommend it. And it just talks about the best investors in the world and what they're like. And so that book I would highly, highly recommend. And I had William Green on my podcast, so you can listen to that episode at myworstinvestmentever.com. I want to welcome everybody on. I'm going to get started in just a minute with the strategy, but I thought to take a minute or two and just talk about some books that I'm reading and some ones that are interesting. And I have to admit that I really like the comment that came from Nan, which says, "Hello, Kun Andrew, you look great today with a necktie." Yes, I've dressed up especially for tonight. I decided that there's nothing better than dressing up nice to feel good and bring good vibes and energy. All right, last book, and then we're going to get started. This book, this is the 48 Laws of Power by Robert Greene. It's a pretty big book, and he has 48 laws, but recently I've been creating a cheat sheet, and this is a cheat sheet that highlights all 48 rules on one page. For those of you who are book lovers, feel free to contact me because I'm always reading books, and I've been developing a book club and having a lot of fun with it. So that's great. Cha-cha-da. Nice to see you, and welcome everybody else who's coming on for this live session We're going to go through a bunch of stuff. Feel free, again, as always, to ask questions. Sam, good evening. Nice to see you. We've got about 132 people coming on, and welcome everybody. And feel free, again, to ask questions. I'm on fire tonight. I don't know what it is. I woke up at 4 a.m. I was running at the park by 5 a.m. And then I was back home, and I've been working all day. I was interviewed by the Thai government for something, for a TV show or an ad thing that they're doing. So that was fun. And that was a fun day. All right. So again, thank you, Nan, for your lovely comment. And also, Chachada, good evening. And Sam, good evening to you. And good evening to everybody out there. It's time to start to talk about the strategy. So here we have, I'm going to share the screen here and show you the update for July. So let's get into this and see what we've got. Remember to ask your questions in the chat, and I'll answer all questions at the end. So what tonight we're going to do is we're going to talk about what happened in the world markets in July and performance review of the strategies. That's all weather inflation guard, all weather strategy, and all weather alpha focus. And then a global outlook that guides our asset allocation, and then current weights of our strategies. And that's, again, the 3 core strategies that we now have available at Phenomena. Remember, I know it's painful to see losses in your portfolio, but investing is a marathon, not a sprint. Remember, emotional decisions often turn out to be costly. To avoid this, we stick to our FVMR framework. It doesn't always outperform in the short term, but we're in this for the long run. What do we mean by long run? We create our strategies for many decades. There's me as a little baby. There's me when I arrived in Thailand, and that's me when I'm 100 years old. Our aim is to create strategies that perform over many decades. And that's our goal for all of our strategies available at Phenomena. So before I go any further, just to say to everybody that's just arrived, welcome. We're going to have a fun time tonight. Make sure that you leave your questions in the chat. Pontep, thank you. I see you said good evening, Ajan. And also Nan says Pelosi's visit has changed AWS portfolio or not? That's a good question. We'll come back to that. That's the first question of the evening. And yeah, Pawi says they want to join the book club. I think Alex can share something with you maybe, and maybe there's a way that we can figure out how to reach out, and we'll share more about the book club. I love books. It always makes it really fun. All right, let's get back to the presentation. Welcome, everybody. And first of all, world stocks have taken a hit, obviously, in 2022. In 2021, world stocks were up 19%, and year to date, they're down 14%. In July, world stocks rebounded by 7%. We're talking about the red line here that is shadowed. There's a shadow above and below. Now, let's look at the performance here. We can see that in July, US and key European markets rebounded. And we can see that China, on the other hand, dropped. This is the whole point kind of global diversification, is that when one's going up, another one's going down. Remember that you can get this same exact document right here by going to valuationmasterclass.com and go to resources, and there you can get it for free without any obligation. Let's look at the Thai money market, which stayed flat. That's the blue line here that we're highlighting. Besides all-weather inflation guard, our bond allocation has been in the Thai money market, which was flat as expected. The main purpose of our money market allocation is downside protection. Also, commodities rebounded in July. All our strategies currently have an allocation to commodities. Commodities have been on a bull run since April of 2020. The asset class gained 6.8% in July. And then gold, it's fallen since our last revision. What we can see is gold closed July at $1,765 per ounce, or down 5%. It's not been the inflation hedge that it's supposed to be, but rather has been pushed down by rate hikes. Let's review what's been going on. So Fed hiked another 0.75. Here we can see Federal Reserve raised its benchmark interest rate by a hefty 0.75 of a point. Most aggressive drive in 3 decades to tame inflation. So they're trying to stop inflation. Interestingly, the hike led to a rally in financial markets. The market may think 0.75 may not be enough to stifle inflation, or that aggressive hikes will result in an early Fed pivot to a lower interest rate strategy. The pivot is what I'm expecting, and that is they won't be tightening for that much longer, and then it's going to reverse. Now, second quarter 2022, U.S. GDP contracted, and the U.S. has entered recession. The U.S., here we can see, is now officially in recession after 2 consecutive quarters of negative GDP. Of course, the GDP in the second quarter was relatively small, but it was still negative. Or has the U.S. entered recession? And here we can see a recession is 2 consecutive quarters of negative growth. And then Batman slaps Robin and said, that's the old definition. Here we can see that the White House decided to change the definition of a recession and basically saying, not claiming that it is a recession to have 2 quarters of consecutive negative growth. Here we can see that Yellen sounds optimistic about the U.S. economy. Yellen says the U.S. economy has entered a new phase characterized by steady, sustained growth. What do you think? Do you think we're in a recession coming, or do you think that we're in a new phase characterized by steady, sustained growth? I would say it's probably more likely we are in a recession. She follows suit and disagrees, saying the U.S. is not in a recession, according to the new definition, of course. Now, one thing we know is that you seldom resolve problems by denying them. This is an ostrich with its head in the sand. Now, Fed Chair Powell admits that he was wrong again. Powell said, I don't think I would do that again. I don't think I would keep policy so accommodative, meaning keeping interest rates low, again, as inflation was already picked up as we did in 2021. Are they being wrong on purpose? Here's a funny one. First, we said inflation was transitory. Then we promised a soft-ish landing. The Fed was wrong about inflation. Is the Fed just trying to manage market expectations with its communications? Will the soft landing succeed, or will Fed crash the market? My answer to that is that I think the Fed will, in fact, crash the market. So ECB hiked 0.5, which was more surprising than the Fed's hike. We can see also in EU, bond markets are screaming. The more you tighten now, the more you'll have to ease later. ECB's new tool has been a failure so far. This is the idea of the fragmentation or anti-fragmentation, where Italian bonds are, let's say that they're yielding a really high amount, that the ECB would buy Italian bonds and sell, let's say, German bonds. And here we can see on this particular chart, let me grab my pen so I can do a little illustration here. What we can see in this area is Italian bond yields. So we're looking at Italian. I'm going to write that out, Italian. And that, let's just say that the Italian bond yields are, let's say, 6%. And we can say that German bond yields, I'm just going to use a G. Let's say that German bond yields are 2%. If we were to say 6% minus that 2%, that would be a 4% premium for Italian bonds. And here, that's exactly what this chart is it's looking at Italian bonds relative to German bonds. And what we can see is that the Italian bonds are, in fact, getting into a higher and higher premium. And that's an issue. The purpose of the anti-fragmentation tool is to avoid large spreads between EU member bonds, which has clearly not been accomplished yet. Here we can see that Italian bonds are still priced at a pretty high yield. And it rightly so. I mean, that's the whole point of a financial market. The whole point of a financial market and a free financial market is that participants can set interest rates where they think that they should be, not central banks. We've gone crazy these days thinking that central banks like the ECB or the Fed can simply pick a number and say that that's the right number. In fact, why is anybody even fooled by that anymore after we've seen so many mistakes from the Fed? Now, the anti-fragmentation tool has led to internal fighting in Europe. Germans are already preparing to sue the ECB on the new anti-fragmentation tool. And it's a prime example of how poor the current Eurozone's architecture is. Why would the Germans be suing ECB? Because the Germans are saying, hey, you shouldn't be selling our bonds to buy Italian bonds. That's not fair. And so that's part of what they're doing. I actually think that, that in fact, what is going to happen in Europe is the pressure is going to be so enormous, not only the financial pressure, but all the pressure related to energy prices now that Europe's not buying gas from Russia or is stopping buying gas from Russia. The pressure is going to be enormous on Europe. And I would say that it's going to be put to the test. The Eurozone may or may not survive the next, let's say, 3 years. We'll see how painful this upcoming fall and winter season is going to be, particularly on Germany, as they start to run out of energy. It's the bizarrest thing that you have a developed country in the world running out of energy. Now, the EU fights about energy too. Here we can see North versus South 2.0, and Spain, Greece, and Portugal reject the EU's call for 15% cuts in natural gas consumption to help Germany. Spanish energy minister, clearly aiming at Berlin, says contrary to other countries, Spain hasn't been living beyond its means in energy terms. Everybody likes to talk about ESG and sustainability, but I always like to ask, did you drive? Did you fly? Are you using your air conditioner? Are you using your refrigerator? Until people start really cutting those things, you can talk all day long about ESG, and things may not improve that much. And here we can see that in Spain, they're saying we're not overspending in our energy. Now, Germany says to stop coal and oil imports from Russia. Germany will completely stop buying Russian coal on August 1st and Russian oil on December 31st. Russia currently supplies 40% of Germany's coal and 40% of its oil. It's like they're trying to shoot themselves in the head. Germany is killing itself. Now, Russia has cut gas supplies to Europe. Russia's Gazprom declares force majeure on gas supplies to Europe. Russia has countered EU sanctions by saying it's unable to deliver gas through Nord Stream pipeline. And this is a crazy twist. We can see that Saudi Arabia now buys cheap Russian oil so that it can sell its own oil to the West. Russia wins, Saudi Arabia wins, and the West loses. It's clear that Germany is headed for an energy crisis. This chart is just absolutely crazy. The yellow line is the German 1 year ahead power price, and power costs are rising like crazy. Politicians ask citizens to brace themselves. In Germany, politicians have warned citizens to be prepared for blackouts, gas shortages, and energy bills of 1,500 euros to 3,000 euros. It's a disaster waiting to happen. And what's going to happen when Germany starts to explode? Now, German people actually are pretty nice, and I'm surprised they haven't been in the streets yet, but they are being cut off from energy. And for what? What's the purpose? What is the purpose? Russia and US could be negotiating, but instead they just go on fighting. I am totally against war, and I don't see any justification for it. And I would argue that for everybody, that from my perspective, the US and Russia could sit down tomorrow. Now, here we see that basic things become luxury. This is two beautiful German girls saying, his house still has heat. That's how you're going to be popular in Germany in the future. Now, China GDP came in weaker than expected. We can see that China second quarter GDP grew 0.4% year on year. So now we have China potentially getting close to a recession. That's amazingly low. Now, this video, I watched this video, and it's terrifying to see what you can see in this video. I'm not going to play the video, but you can just see there's a group of people here, And these people, and then all the people that are up here, most of them are just depositors. People like this lady with the hat, this lady with the mask on. All of these people are depositors. And what's happening is that these guys are rushing in and fighting and going in and pushing into this bank to take control. This is like a bank run in China. You've got to be very careful. What's happening in China is very dangerous. We could see banks starting to collapse in China. Now, here we can see the printing goes burr. Chinese M2 growth printing at 11.4% in June. In other words, it is printing. They're printing money in China, which of course feeds inflation, but probably is needed to support the banks. Now, let's keep in mind China's size. The Chinese real estate market is the biggest single asset class in the world, with an estimated market value of roughly $55 trillion. That's larger than the US stock market. And Chinese real estate output just shrunk by 7% year on year in second quarter. As we all know, the Chinese property sector is under tremendous pressure. So the key takeaways I want you to get from this discussion are: first, Fed hiked 0.75, and the definition of a recession was changed by the Democrat leaders. The ECB hiked 0.5, and the EU is fighting internally. German energy crisis appears inevitable, and China reported weak numbers worsening global slowdown concerns. So let's do a performance review for the month of July. First, we're going to talk about Inflation Guard, one of our strategies. This is the low risk strategy. And Inflation Guard was slightly above the 40-60 strategy since inception. So as of 8th of August, the strategy was 0.3% above the 40-60, meaning 40% bonds, 60% stocks, 40% stocks, 60% bonds, sorry about that, and 5% tilts to commodities, world infrastructure, and gold drove up the return. So let's now look at all-weather strategy. Here we can see it's above the traditional 60 equity, 40% bond portfolio. Since inception, the strategy was 6.5% above a 60-40 portfolio. And here we can see that AWS was below the 60-40 in July. So the prior one was looking at it over the period since inception. And we underperformed by about 3% due to low equity and high gold weights. Yeah, we were right on commodities, but the bonds stayed flat and the gold was a worse performer. But again, remember, you cannot be right every single time. We are coming to the end of August. We're going to be reevaluating the portfolios, all of them, and that's when we'll tell you more about what we're doing next. Now, AWS has lost less on 9 out of the 10 worst days. The most recent day is the 13th of June, 2020, when the market fell by 2.2% and AWS fell by about 1.5%. So AWS has done very well at protecting and limiting the downside. Of those days, we've had 90% of the days that we have beaten the market in the downside. And here you can see that AWS outperformed a 60-40 portfolio in 61% of months. That means 25 out of 41 months, the all-weather strategy has beaten the traditional. But it didn't beat it this month. You can see the 60-40 really crushed us this month. It's not that common. The last time that we had that type of outperformance by the market and underperformance by AWS happened here in November of 2020, and it happened again in here in April of 2020. It can happen, but what I would say is that the probability so far is about 60% of the months we're outperforming. All right, let's look at all-weather Alpha Focus. Here you can see Alpha Focus is below the 60-40. As of 8 August, Alpha Focus was 0.9% below the 60-40. Now, Alpha Focus is held up better than World Equity, which is the green line, and Alpha Focus was 4.5% above World Equity. And World Equity is probably a bit of a better benchmark for Alpha Focus because we are trying to be more aggressive there. Here we can see all-weather Alpha Focus was 2.5% above the 60-40 portfolio. So we did good in the month of July. So Alpha Focus was 0.5 below the world equity in the month of July, though. We did see equities rise quite a bit. And our 20% tilts to world energy, India, and commodities drove the solid return. You can see all three of those outperform during the month of July. All right, the global outlook that guides our asset allocation. Before I continue, remember you can ask questions in the chat. Make sure, ask questions in the chat. And that's funny. Anne says, oh, I thought you're going live from CoffeeWorks office. Yes, maybe what we should do is do an event at CoffeeWorks office, and we'll have a lot of coffee there and a relaxed time live. All right, let's continue on, and let's look at the global outlook that guides our asset allocation. So the Fed raises rates, but Biden talks about stimulating the economy. It's almost as if reducing inflation is not the real purpose of the Inflation Reduction Act. Whenever the U.S. government comes up with a name for a new law or a new act, as they call it, or a law, basically, it's just the opposite of what they say. In this case, it is the Inflation Reduction Act, and they're going to cause inflation to rise. That is my impression. Soft landing is the goal of the Fed. Powell says, I do not think the U.S. is currently in a recession. It doesn't make sense that the U.S. would be in recession. We do want to see demand running below potential for a sustained period to create slack. We're trying to do just the right amount. We're not trying to have a recession. But my point is that ultimately they are going to cause the recession by the higher and higher interest rates. I was just watching a video on YouTube yesterday where they were interviewing people just out at the supermarket and all that. And man, they were really complaining back in the US that the cost of everything is rising so high and wages aren't rising that high. Now, the Fed seems to have changed its communication strategy when they said, we think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral. So they're no longer going to give guidance. Remember, by the way, if you want, you can ask a question in the chat and I'll do my best to answer it. Now, this is an interesting chart. What we've done is rebased the balance sheet of the Fed, the ECB, and the Bank of Japan back to 100. And that is back to January 2020. And what we can see is, a massive expansion in central bank asset, meaning Fed assets in particular, the red line. And this is quantitative. I'm just going to grab my pen here. This section here is quantitative easing, where we saw it shoot up massively. And this is what they're saying is quantitative tightening. But you can see it's not falling. This would be quantitative tightening if the balance sheet of the Fed started falling. Now, I'd like to just explain this just a bit so that it's very clear about what's happening with quantitative tightening and quantitative easing. The government, the Fed in particular, says, and I'm just going to try to pull up let's try to pull up my face here. See if I can do that. There you go. So what I wanted to say is that the Fed is saying it's going to do quantitative tightening. But the fact is, I doubt that they're going to be able to do it. I doubt that they're going to be able to draw that red line down, meaning they are no longer going to be buying treasuries, bonds from the government, or mortgage-backed bonds, which they generally will buy from the government. They're not buying these things. That's their plan. Now, the problem with this is that the U.S. government, the Treasury Department, still needs to get money to spend because the politicians keep wanting to spend. Well, the U.S. government gets tax revenue, but they need more than taxes. They need cash coming in from issuing bonds. And if they go and issue bonds right now at such low interest rates, who's going to buy those bonds? It's not going to be China. It's definitely not going to be Russia. And many other countries across the world are less interested in investing in U.S. treasuries, particularly after the dollar's been so strong. At some point, they're going to get worried that the dollar is going to start to weaken. And as a result, the buyer of the bonds, of the U.S. Treasury bonds, If the Fed backs out of the market and no longer is a buyer, there's not going to be new buyers coming in. That's different from 5, 10, 15 years ago as the Chinese kept buying in the market. They're not going to do that anymore. And the result of that is that the yields would have to go up super high on US Treasury to tempt the Japanese or others to invest in US Treasuries. And that means interest rates would go up. And that can't happen very strongly because it's going to cause recession, damage the market, and the like. And that is the reason why I say that the Fed is not going to be doing quantitative tightening anytime soon. So if you have any questions about that, feel free to ask any questions in the chat. I can try to explain it a little bit more later. Whoops, I pressed the wrong button. Hold on. All right, let's go back to the presentation, and I'm going to talk about how a September Fed hike is priced in. The market is priced in 100% certainty of another Fed rate hike at the next FOMC. September is very close to the November midterm elections, and I would argue that it's getting harder and harder. If the Fed keeps raising interest rates, it's going to crash the economy, continue to crash the economy, and continue to crash the market. And the result of that is that the Democrats are going to lose their seats in the House in the November election. So since March, the market expectations have shifted to a much more aggressive Fed. So you can see the red line is the latest line, and we can see that the market is expecting, if we just go back to March of this year, the market was expecting 2% Fed fund rate by the end of this year. Now they're expecting 3.6. So they are definitely getting more. The market's expecting the Fed to continue to increase interest rates. Now, one of the problems about that is that the most powerful monetary impact or market or economy impact is the unexpected change in the Fed. And that's when the Fed did a 0.75. It was a huge move. But now what you have is the market is already expecting the Fed is going to raise interest rates. And so when they do, if they do, then what you'll see is that the impact actually is kind of neutral because the market is already expecting that. So though the market also expects that the Fed needs to ease in 2023. So the critical thing now is that there's this expectation that by the end of this year, the Fed funds target will be 3.6. But by July of 2023, we're going to see that the Fed funds rate is going to be 3.4. That means it's going to come down over time. And that is the market pricing in a Fed reversal that they're doing, or Fed pivot, where interest rates are going to eventually come down. The Fed needs to balance inflation with increased recession expectations. Now, let's look at the strong dollar. Everybody knows about this because all the emerging markets are getting crushed with such a strong dollar. It's now at 112 for the real broad dollar index. And so the Fed actions are likely to result in a stronger dollar and less global liquidity, which can hurt emerging markets. If it's an emerging market that's got a lot of debt in US dollars, they're facing a lot of trouble. If it's an emerging market that has to import a lot of its food and energy and fertilizer, and their currency is devaluing, it's really painful for them. That's what's happening to a lot of countries in Africa. Less so in Thailand, but more so in Africa. But Thailand is not immune to this, ladies and gentlemen. You may feel like inflation has not gotten out of control in Thailand. Why is that? Because the Thai government is intervening to support the price of oil, to support the price, to cushion the rise in gas prices, to cushion the rise of oil prices to the consumer by having some sort of subsidy. But at some point, it's possible that the Thai government releases that. They can't hold on and subsidize forever. And the result of that is that prices could jump really high. I'm not saying that that happens. The best outcome for the Thai government is that they continue to subsidize the oil and the gas, and eventually the oil and gas start to fall. That's the dream. But I would argue that with this current situation, it's very dangerous if the government keeps subsidizing, because eventually they will run out of money. So we could see further rate hikes in the EU as well. The hike in January brought the key rate to 0 in the EU instead of negative, which has been the case since 2014, the negative. Like the Fed, ECB has decided to stop forward guidance and use a meeting-by-meeting approach. It just seems like they just follow each other. Trust me, I just want to say something that I want to get across very clearly. These technocrats can never predict the markets. They can never do what markets can do with free trade at setting interest rates. But yet we keep putting them up on a pedestal. Oh, what's the Fed going to do? What's the ECB going to do? The fact is, these guys are just following each other. And the reality is that they cannot replace the value of the market, which is the value of the market is ultimately setting prices. So let's come back to the presentation. And though ECB President Lagarde is reaffirmed the commitment to the 2% inflation target. Now, we think the course will be reversed. As you can see, central banks are communicating that they're going to get inflation down, and investors seem to buy that rhetoric. We still think central bankers and politicians will change course and return to accommodative policies as soon as something breaks. That's what I'm saying, is the market can break, the bond market can break, Italian bonds could break, high yield bonds or really risky bonds in the US could break. The US inventories are up, which could signal a slowdown in consumption. Here we can see inventories in the US for retail going up quite dramatically. That tells us that one issue here is that they're not selling that much. Here we can see yield curve inversion has been an accurate predictor of recession. I just want to highlight that below the line is the yield curve inversion. And we can see that recently it's been below the line. That signals that there's an inverted yield curve. So if inverted yield curve is a sign, well, then I would say the US is either already in recession or heading for recession. So bonds are typically a safe place to be in recessions. Safer assets like government bonds are typically performing well, though with high inflation, low yields could still lead to negative real returns. We typically don't allocate to bonds to speculate in the upside, but rather use it as a way to protect capital over time. Now, commodities still look attractive. Here we can see that despite China's lockdown, global oil inventories continue to surprise on the downside. Keep in mind, we have this huge push for climate control that's trying to reduce the amount of natural gas and oil that's out there. And we can see also that it's just been coming down a lot. So from this perspective, it's hard to see that oil prices are going to come crashing down anytime soon. Oil inventories appear to support higher prices of oil. Here we can see that energy prices to remain high. WTI, World West Texas Intermediary oil, now is at $91 a barrel. Now, in this chart, I've rebased both oil global and European natural gas, and we can see the gap is enormous as European gas has become super expensive. Europe's Russian energy dependence is going to continue to influence the energy markets. And then there's fundamental support for energy prices. Ukraine war could lead to further supply shocks. Energy prices can also remain high due to past underinvestments in new projects. And besides energy, Russia is an exporter of many industrial metals, and Russia and Ukraine are both important exporters of soft commodities. A reopening of China could lead to increased demand for commodities, but right now, that's down. High energy prices feed through to food. Now, we have seen that the food prices, particularly the cereals prices, has come down pretty substantially from about 180 to about 145 on this chart. This is, again, going back, this is the index over time, but the meats have been continuing to rise. Natural gas is used in fertilizer, and higher fertilizer costs lead to higher grain prices, meaning cereals. And cereals fell back in July. Corn is a primary input for feed grain of livestock and poultry, which is driving up meat prices. Here we can see that Russia and Ukraine accounts for almost 25% of the global grain trade. It's massive. And the World Food Price Index hit a record 160 in March and is still at 141. Good news, it's down from 160, but I think the bad news is that it probably could peak up again. Export bans on food could exacerbate the food shortage and push prices up further. Oils and cereals drove down the index in July, falling 19% and 11% respectively. Now, commodities are set to go higher, in our opinion. We still think demand for necessities like food and energy, inflation, and supply chain disruptions related and unrelated to the war in Ukraine are going to drive the asset class, meaning commodities, higher. We also keep gold as insurance. The war in Ukraine spurs uncertainty, and inflation expectations could rise, making gold attractive, though expected rate hikes and recession concerns are negative for gold. So what are the key takeaways? First, central bankers appear to be raising rates into a recession to try to stifle or slow down inflation. We see opportunities to allocate to sectors and countries within equity. That's world energy and India. And demand for necessities like food and energy, inflation, and supply chain disruptions are going to drive commodities higher. And bonds and gold we have in our portfolios to protect capital. Let's look at our current weights for our strategies. Here we can see that we make no change in the allocations in this review for Inflation Guard. We just launched it, and you can see 60% bonds and 30% equity right now, and 10% others, which is split evenly between commodities and gold. The average bond allocation, well, Inflation Guard exposure throughout the backtesting period was on average about 61% for bonds, and we're currently at 60. So we're about at average. The strategy aims to earn some premium through 5% allocations to world infrastructure, world energy, and commodities. And a 5% gold allocation is held for extra capital protection. Let's look at all-weather strategy right now. There was no change in the Inflation Guard. And here we can see that we make no changes in this performance review. We're still 25% stocks, 25% bonds, 25% commodities, and 25% gold. Now that stock strategy, you can see 25% to equities is split equally between US, developed, Europe, Japan, emerging markets, and Asia ex-Japan, Asia Pacific ex-Japan. This means that we're significantly underweight the US. We have a minimum 5% target allocation to each regional equity so that we don't tilt too aggressively in one way or another. And commodities expected to remain strong. AWS is defensively positioned with 25% target allocation to each asset class. Recession concerns and inflation motivate our positions. As mentioned, we think commodities are going to remain and keep bonds and gold allocations high to protect capital. And finally, the alpha focus strategy. Here we can see, again, we make no changes. We maintain our overweight position in energy, India, and commodities. We have a 73% target equity allocation in this strategy over time. Now, energy prices to remain high. All-weather alpha focus has opportunistic tilts to world energy, India, and commodities. We've already covered that supply-demand imbalance appears to support high energy prices, and demand for necessities like food and energy, inflation, and supply chain disruptions are going to drive commodities. We think India can outperform the world stock market, and maybe it just outperforms by not going down as much. Indian IT companies have reported rising backlogs and struggle to keep up with demand. The new Indian government budget is focused on infrastructures, renewable, and healthcare spending to continue fast GDP growth. And continued budget deficit should instill confidence about the Indian government support. Now, what are the risks? Global recession pushing down stocks. Rate hikes could push down bond returns. But worse, if central banks are too aggressive with rate hikes and QT, it could crash stock markets. We're mainly exposed to Thai bonds, hence BOT's actions impact the most for our bond allocations. And Alpha Focus has a 20% tilt to Indian equity, so the strategy would be negatively impacted if the Indian market were to crash. What about inflation? If it quickly gets under control, that's a risk for our strategy. Why? Because we're positioned to benefit from rising inflation through our commodities allocation. Weak Chinese economy could reduce commodities demand, and that leads to lower prices. And our other commodities could fall with energy prices too, as it's part of the production cost. So before the Q&A section, just to remind you, our next 6-week valuation masterclass bootcamp starts on October 10th. If you sign up now before August 15th, you'll get my Achieve Your Goals course for $147. That's a value of $147, and you'll get that for free. All you have to do is use the coupon code FINNOMENA, and you'll get $700 off. That's a great deal. We hope to see you in there. It's time for Ask a John Andrew, and I'm going to move over to the questions and try to answer the questions that I see. So let's go back up. Remember, if you have a question, make sure to type it into the chat. Here we can see the first question is from Nan, and Pelosi's visit has changed AWS portfolio or not? No, it has not changed the portfolio. Remember that we're not tilting the portfolio based upon events that are happening, all the time. My point, I would say, is that I didn't like to see Pelosi do that because I felt like there's so much tension between China and the US right now that it doesn't make sense to spark that tension. But we did not make any change based upon that. Supergone says, do you think it's a good time to invest in bonds, government or private sector or commercial bonds? I would say that the worst is probably over for bonds. We saw that in the first quarter of this year where bonds had a very, very tough time. So I would say that I wouldn't be too negative on bonds right now. I think that there's still some opportunities. And remember, if the market crashes, bonds are going to hold their value over time. All right. So B. Onuma says, since there's a debt crisis in many countries now, how much risk if we allocate our investment in bonds? I would say that this is why when we look at bonds, a lot of times we look at government bonds because the risk of default is much less. The risk that you have with bonds globally is also currency depreciation or strengthening of some currencies like the dollar. If you put money into US bonds, you would have some gain in the bond, but also some gain in the dollar. But that's not the case with all currencies around the world. And so I would say that I'm okay with a bond allocation right now at 25%, which is pretty high. Nan says, one day Yellen and Powell will admit that there were late recession. Oops, we did it again. We did it again. Yes, that's true. It sounds like a song, right? Okay. Anne says, if Europe will get worse, either from climate change effects or etc., would it be that the European stock markets would not be impacted that much as some innovation could be developed there? Results of that, they would probably be relocation to another region, which costs land or price increase or not. So basically, the question really is like, how's Europe going to deal with the situation? I would say that innovation across the economy is hard to happen when oil prices and gas prices are super high. It's just a really painful time, and all that businesses are trying to do is survive. So to answer your question, I would say that no, I don't expect some innovation to come out of this situation. Now, what I do expect, and remember, always remember that recession is the cure. Inflation or the boom is the problem. The bubble or the boom in the market's a problem. In recession, and when the economy falls and the market falls, is the solution. What do I mean by that? First of all, bad companies die. That means good companies survive, and they survive with less competition. So profit margins of good companies that have survived will remain high or even get higher. And that basically is the natural cycle of the free market capitalism, is that companies will have to die and other companies will get strong. So to finally wrap up that question about Germany, what I would say is that I think that we probably have another leg down for the German markets and for the European markets. But I would say that we could be 1 to 6 months away to starting to allocate again to Europe because it's so bombed out. But I'm not doing that allocation yet. Not yet. Okay, virtual hug. Thank you very much. All right, let's see. What else do we got? Kritsana says, can you estimate when will the portfolio get profit? Well, I try to estimate that. And basically what I'm trying to do is get profit every day, every week, every month, and every quarter. But we have to accept the fact that you're going to win some and you're going to lose some. So some of the portfolios have done okay, but over the latest period of time, I'd say our performance hasn't been great. But that doesn't mean that we change the strategy and the way we do things. We're stick with our methodology, the FVMR methodology, and revisiting every quarter. And I think that, Kritsana, this is a good chance also to mention that we will be changing the portfolio in the next 2 or 3 weeks. We'll start working on the modifications, if necessary, of our current portfolios. And we will submit all of those to Phenomena for them to review and internally bring out to the client base. So the point is that we don't know what's going to happen by the time we start reevaluating the whole portfolio. So we could make some very big changes when we come out with our new strategy. All right. Sati Mehdi says, is it time to invest more on AWS and Alpha now, or should we DCA over the next 6 months? I would say that it's getting close that if you have some, let's just say, forget about all weather, alpha focus, or anything like that. Let's just talk about you investing in what you are investing in. The purpose that most people would benefit from is just following DCA. DCA is a great way of consistently contributing to the market. However, there is one time that you could break DCA a bit, and that is if the market really crashed. If the market really crashed, there's nothing wrong with adding some more money to the market. Now, you'll never know if the market's at its bottom, but you can definitely know when the markets is off a lot. So to answer your question, I think that your thinking is right, where as these markets are coming down, things are negative, performance isn't great for anybody. I would say that that could be a time that you increase allocation, not just to my strategies, but to whatever it is that you're investing in. All right, next question from Best, the Best. I suppose your view is there's still high risk of recession, right? If it is so, is it okay if I hold cash? Yes. I think that the thing to think about is the simplest way to think about investing best is to think about I hold cash or I buy stocks. That's it. You don't have to actually own all kinds of other asset classes. If you just own cash and you own stocks, you would do okay. You don't need sophisticated methodology. Now, the fact is that most of the time you should be owning equity, probably 90%, and maybe cash 10%. But when the markets start to come down, that's the time that you want to take that cash that you got and start to allocate that to the equity. That is a little bit of market timing there, but there's nothing wrong with holding cash. But be careful, because before you know it, we could be at the bottom of the recession, the bottom of the market, and next thing you know, you miss it and it starts flying back up. So that's the risk of being out of the market. A says, I still keep S&P index in the port as it will big loss if I adjust port as your recommendation. Can I DCA it now? I think there's nothing wrong with DCAing S&P index right now. My portfolio, my strategy is at 25% for the equity portion into the US S&P 500. But if you're talking about long-term and you're talking about DCA, I would say there's nothing wrong with continuing DCA there. Now, it's important to mention that, remember, I'm not your financial advisor. You are either the advisor yourself and you're making your own decisions, or you have an advisor at Phenomena. Make sure that you're talking to your advisor about your ideas, because there's no way I can know anybody's personal situation, your tax situation, your income situation, and all that. So it's always important to remember that I'm not your advisor. I'm presenting a strategy, but Phenomena is really the one that you want to continue to work with. All right. PPSS Sock says Buffett keeps buying Oxy up to 20% now and expect to buy more. What is he thinking? Well, basically Buffett is buying oil, and he's buying oil because he just can see that the pressure from the environmentalists has caused the oil companies not to spend almost at all in new oil drills and new oil discovery. And so the point is that he is continuing to buy oil companies. So Oxy is Occidental Petroleum, which is a Los Angeles-based oil company originally, and it's pretty, famous in LA when I was there. But yes, I think that he is betting that, number one, oil companies are not able to add new supply very easily. Number two, I think he's betting that tensions and Russian oil is not, let's say Russian oil is not going to come back on the market. Number three, he's probably looking at Germany and seeing that Germany is not able to produce enough renewable energy to replace oil and all that. And so the result is, I think he's betting that ESG won't really play out. And we can see that Occidental Petroleum has been about flat, let's say, for the last 12 months. That's my thinking on that. Wat Shirapong says, what? I think maybe pressed. Okay, here. Wat Shirapong says, when you plan to come in interest into China again? Yeah, I think that, China is getting there, but we're not tilting into China yet. But I would say that it's probably getting close, a little bit like Germany. With the economy down in China, the market down in China, at some point it starts to look attractive. And who knows? It could be that in our next rebalance, we do, in fact, rebalance towards China. But I don't know until I've looked at everything at the end of this month. Wow. Well, a lot of great questions. If you have any more, feel free to put them in now. Otherwise, I just want to thank everybody for coming in and listening and understanding more about what we're doing. I know as I go back to the beginning of the presentation, remember I said, I know it's painful when the markets are volatile. I know it's painful when we're losing or not outperforming. It's great when we are. It's exciting. But we have to be calm through the times that we're underperforming. Stick with our method. Stick with our strategy. Know that it will underperform sometimes, but just keep staying on the course. And that's really the message I have for you. No matter whether we outperform or underperform, I know that it's going to reverse in the future. So I just stay the course. I want to thank you all. It's 7:57. I try to keep it to an hour. So I'm going to end here. And I want to thank you all for being on this live stream. Feel free to ask any other questions to me throughout the weeks and months. I'm happy to take them. You can ask your representative from FINNOMENA to talk about and ask me any questions. So with that, I'm going to sign off and say, Wadika. Thank you, everybody. And I appreciate you taking the time to listen to what I've got to say and be involved in the three strategies that we've got: the all-weather inflation guard, the all-weather strategy, and the all-weather alpha focus. Have a great day, and I'll see you in September when we are going to talk about our new allocations. Have a great day and a great long weekend and holiday.